this is take two, right? Take two. At some point, I bumped my mic off evidently, so we're gonna redo. um, I don't know when it cut out, so I'm gonna start over a little bit, briefly. I might look at the video before I decide whether I need to come back or not. But ultimately, in chapter 6, there's only 3 terms that are of much importance. The first one is on page 221. General long-term liabilities. Make sure you check that out. It says general long-term liabilities are those that arise from activities of governmental funds that are not reported in the proprietary or fiduciary funds. I can hear this teacher. Proud of your C. Um, so that's the first one. And then there's 2 more terms to check out: debt limit and then debt margin. All right, so debt limit is something you'll experience whenever you go to buy a house. Um, Essentially, you'll go to a banker or a mortgage lender, and they're going to say, all right, how much money you make per month, right? Well, it might be annually. Then they're going to put it down to a month. So let's say you make $36,000 a year in your first job. Hopefully, it's more than that, right? It better be. But anyway, that's nice, easy math, though, right? So you get $3,000 a month. Um, but anyway, with that, you're going to say, well, your debt limit might be 40% of that. So, they don't want you to have too much of a house payment to where you can't afford to buy a car if you need to, or get food, or to, or save some money up from repairs or whatever else. So they're going to give you a debt limit. Say, well, your debt limit can only be a certain percentage of um, your monthly income. Well, that's the same thing would apply to the government, because every year they're going to have taxes, right? So the taxes will be a certain amount every year. The tax base will never grow. Assessments might, but in terms of there's no new property unless you're like somehow annexing, which some people try to do that, and usually it's pretty negative when they try to. But your tax base is a certain size. Pretty much every year, if you're a government, how much money you'll have from taxes, and so you'll put a limit on yourself so you don't get too much debt, because that's just going to burden future taxpayers. So that would be debt limit. And then the margin, debt margin is the other term, and that'd be the difference from what you already have outstanding and what you're allowed to have that cap, right? So if you're allowed to do $1,000,000 and you already have $600,000 outstanding, then your debt margin would be $400,000, which is the amount that would bring you up to the cap or the debt limit. Those are your main terms. There's also on page 223, there's some other terms you might want to check out. The types of bonds, I'm not going to spend any time on it right now, but there's sinking fund, term bond, regular serial bond, deferred serial bonds, annuity serial bonds, and then irregular serial bonds. So check those out for terminology, but you're talking about multiple choice questions. Well, let's get straight into the illustrative journal entries that are on page. Well, they're on the EOC, the Chapter 6 EOC. I did leave out all the multiple choice questions that are going to be on the quiz, or that I might have discussed in class at the end of the book. You'll get those in the Learn Smarts, so you should be fine in that regard. Also, you have the ebook as a resource when you're going through the quiz chapters, multiple choice questions. You'll be able to see the ebook to assist you in that regard. All right, so let's look here. So this is question 1. Okay, talking about debt service, illustrative journal entries. 1, 2, 3, 4, they're all independent of each other. Okay, so it says up here that these are unrelated transactions. Okay, so 1 is an entry, 2 is a total separate entry that has nothing to do with the first one. All right, so we're starting off with here, general fund collected and transfers some tax collections to the debt service fund. $600,000 will be the principal that we're going to retire, and that makes the $150. The difference would be the interest payments on that $600,000, or yeah. So starting off with this first one, we're going to have record the receipts of cash from tax collections. Okay. So this is in the general fund. You see, we got general fund entries, we got debt service entries, and we got just a general accrual basis, government-wide activities down here. So within the general fund, we got to record that cash coming in of $750,000, and then we got some revenue to record. We're just gonna call it just straight up revenue. Now, obviously, that's not very descriptive, and we saw when we did these in the general fund that you have to have a subsidiary ledger to keep up with these types of revenue. But the control account that we'll use here is just the $750,000. So here, number two, or second part, we're going to transfer this 750 to the debt service fund. So we got to have a credit to cash for 750, and we're gonna have a debit to something. What the heck are we gonna debit, right? So this is gonna be an operating, just be a transfer. We're gonna transfer it to a different fund. So it's an inter-fund transfer. So let's try that and see what we see. Inter-fund transfer. It's just a transfer out. It's going out of the general fund and into the debt service fund. But because it's a negative, or in other words, just transferring it out, it's gonna be a use, not a source, right? So it'll be a use. Okay, now the debt service entries. Okay, so we're going to record the transfer of cash collected. So this will be a cash debit, right? 750. And this will be a source as opposed to a use. So other financing sources, okay, right there. Interfund transfers in. That's where it's coming in, right? So that's nice and easy. And now we're going to record the payment of principal and interest to retire the bonds. All right, so here, what we got here? All right, so record the payment. So we can have a cash credit, okay, of course. And now this is going to be expenditures, right? So expenditures, we're going to have bond payment, interest payment, right? So expenditures, principal, and then expenditures, interest. There we go, right there. Okay, so that'll be the debt service fund entries. Okay, not very descriptive. Remember, why is this not a payable being paid off? Because we don't do payables in debt service funds unless they are less than a year. Okay, this is long-term debt. Okay. Now let's look at the general activities. We got to record that tax revenue. So here's the cash coming in. Come on, man. Fingers are on the wrong buttons. And then, so there's our cash coming in. This is going to be some sort of a revenue. So general revenue. Taxes, right? It's tax money. Okay, so there's that. And now we're going to record the payment of principal's interest to retire the bonds. Okay, so the payment's going to be a credit to cash. We know that. It's a payment, cash going out. Now we got to have two things here. We got to have a debit to the bonds payable, and we're going to have a debit to some sort of an interest expense, right? Because remember, we're in the government activities. That's not expenditure. Instead, we use expense. I got bumped off again. Let me back up and we'll review it real quick. I think when I'm going down like this, it's knocking my mic up a little bit, so it's going to be annoying. I say I need to not look down so much, right? I think I caught myself there though. But anyway, the 150 will go here. So let's kind of review here real quick and see what we got. Again, here's the cash coming in. And here's us, recording the revenue as tax revenue. All right. And then down here, you see the cash going out. That's the first thing I did. Of course, then we're going to need a bonds payable. Okay, and it says that these are serial bonds in the question. So I put serial bonds payable. And then expenses, it's interest expense. Okay, it's formatted a little weird because remember it's going to go in that statement of expenses. Interest on long-term debt. There's our interest expense. Okay. All right, I think we're good. I don't think I missed up too much there with my mic cutting out. Hopefully I didn't. I'll have to review the video. Again, this is a learning process for me too, right? This is the first time I've done accounting um, at my house with this headset. And what it is I lift the bar up that cuts the mic off, and I think I'm hitting my shoulder a little bit with it. So I'll try to be careful going forward. Okay, number two. Number two is totally independent of number one, so don't worry about number one. It's done. It's gone. Okay. Number two, $5 million interest. Issue of serial bonds to finance capital projects was sold at 102, and there's some accrued interest to deal with. Okay. The accrued interest and premium recorded in the debt service fund. The accrued interest on bonds sold must be used for interest payments. The premium is designated by law for eventual payment of bond principal. So in other words, the premium is going to be transferred immediately to the debt service fund. All right. So in the capital projects fund, okay, so capital projects fund, that's where we're going to record the $5 million issue. Okay. So they're going to get the cash, the $5 million in cash. Okay. And it's going to be a financing source, right? That source being proceeds from serial bonds. So let's see, we're going to have other financing sources, proceeds on bonds, okay? They didn't have serial, that's fine. So that's going to be our first entry and our only entry within the capital projects fund for this transaction. Show the cash, show the source coming in, okay? And then they'll use that $5 million to build sidewalks and bridges and whatever else, bike trails, all that important stuff. Anyway, debt service fund. All right. Now the debt service fund, we got to put the principal in, not the principal, premium in. Okay. Put the premium in there, and the accrued interest. Okay, because it's got to come out here as well. So the cash coming in here. Let's see. So that's going to be the amount of cash. Okay. Well, the amount of cash is going to be what, $50,000. The accrued interest, and 2% of the $5 million. Well, 2% of $5 million is $100,000, right? So we're talking about $100,000 plus 50. So the cash coming in is going to be $150,000. Okay, the 100 is going to be the premium. Other financing source premium. That looks good. Okay. And then we're actually going to payable, right? I just said it earlier, right? So we'll have payables as long as, let me make sure I don't say this wrong. Well, no, payables coming in a minute. We're going to treat it as revenue. Okay, it's gonna wash out immediately with our first interest payment. Okay. I forgot I'm in the fund here. So revenues, just generical revenues will be where we put that $50,000. Now on a subsidiary ledger, we're going to put that's accrued interest. Okay, it's kind of like it's almost not really revenue because it's prepaid. It's a prepaid payment of a future interest payment, but we're going to put it as revenue. All right. Ultimately, that first payment will wash it out and it'll be fine. All right. And now 2F. Okay. Now in the governmental activities, we're going to have cash coming in. Okay, so this is going to be the whole thing put together. Picking up your pace. Oh, I see. but they can also like go back. You know what I'm saying? But I appreciate it. I will slow down a little bit. I definitely tend to get worked up. I got a buddy, a friend of mine must be enjoying this wondrous stuff from work. He's giving me some tips, which is good. Um, so we got the cash here. So how much cash came in? Well, you see it up here, right? So you got the $5 million issue, plus the $100,000 of interest and the $50,000 of accrued interest. So the total cash coming in is 5.1. There we go. Let me try it again. One too many zeros. $5,150,000. If I can get it typing in right. There we go. Okay, so of that, of course, 5 million of it is the bonds payable, and not enough zeros that time. So this is going to be our bonds payable. Let's see if I can get a little bit further. And it is a serial bond, so we'll do serial bonds payable. All right. The second thing we got is the premium. So we got our premium on bonds payable. There it is. Just like we would do an intermediate or even intermediate. Principals 2 maybe 2. $100,000. And now we got to do something with this accrued interest, right? So it's going to be a payable because it is, it is. I think it's payable. Let me double check. Yeah. Because they paid in interest. That's not really ours. Okay, they're kind of going to get it back, but because it's already been accrued with that debt interest, with that debt instrument, we're kind of like holding it to give it back to them when we make our first payment. So we're going to put interest payable. Okay. And that's going to be that $50,000. Okay, so there we go. So that's number 2. And we'll do number 3, and then I'm going to start and stop. And then we'll, so I had the clips smaller. I don't want these giant clips. All right, but let's do number 3 first. So 3 is dealing with lease payments. Okay, so lease payments, it says capital grants was probably a capital lease, which would make some sense to us. So let's look at our first one, which is and this is in the special revenue fund, record the cash received as a capital grant. So we're going to have cash here coming in the amount of $110,000. So 110. This is going to be a revenue, right? So within the special revenue fund, we're just going to call it a revenue. Now, obviously, that's not enough information. You'll have a subsidiary ledger where that $110,000 is shown as a capital grant being received. But the control account that we use in this entry is revenues. And then we're going to transfer it out. So we're going to have another one of those transfer out things going on here. We're going to have the cash leaving, kind of washing out to go to debt service. This is going to be an other financing use. Okay, it's going to be an interfund transfer out. All right. All right, going on to the debt service fund. We got to show the money coming in. Okay, so this is going to be cash coming in. And this will be another financing use, not the use source, right? Source. Interfund transfer in is a source. Like that, right there. Interfund transfer in, $110,000. And now we're going to record that payment, right? So the payment, it's got it divvied up for us. Well, it tells us how much is interest. So we got to calculate, making me do math. I don't have my phone in. Do I? I'm gonna have to figure something out because this is not gonna work. I don't know when it cut out either. Let me finish this up and have a look because my mic's going out and I don't see it. It's annoying. We'll figure it out. Don't worry. I'm a smart guy. I'll figure it out, right? Of course, it may have just cut out right then because I did look down at my sheet again. It doesn't take. Maybe it's the collar. I might go put a T-shirt on. Anyway. All right. Let's finish this up. This last little part, then I'm gonna go review the video and cut out at 3D. Okay, thank you, man. I appreciate it, Amanda. All right. Did it get my description? What I said for 3D was I hoped it would say principal on leases and interest on leases, but it doesn't. It's a very generic entry there. And this is going to come back up later when we get to problems 2 and 3. But I think I'm going to go put a T-shirt on for the next segment. I think this is hitting it. But anyway, and what I did not like about 3E was that the program revenues, I was thinking it would be something like program revenues, capital grants, and it doesn't say that because I know that's something on there when you do that statement of expenses. You have your total expenses, and then over to the right you've got your capital grants and stuff, but it's not how they want it here. They want it as general government. Okay, I do might have my phone here. All right. So that was 3E was very difficult to me at first. All right, so let's go to 3F. Yeah, I still got audio. Recording the principal and interest of the lease paid. Okay, so this is not too bad. This is obviously we're gonna have a cash credit of $110,000. Okay, we know what the interest principal is. It's gonna be a $94,191 lowering of the payable or the lease obligation, and then also we're gonna have some interest expense of 15,809. 15,809. So we're looking for some sort of an interest expense. Okay. And here we go. See, this here says interest on lease. Okay, and I would like that up here too, so that way I know within the debt service fund there are leases being accounted in there as opposed to just bonds too. So interest on lease, and then this is going to be some sort of a lease obligation. And I would think that's probably it, right? Lease obligations payable. All right. So I'm going to pause for a minute, change my shirt to a T-shirt. Hopefully it won't look too bad, right? and see if that helps with the microphone. And then I'll be right back shortly for 4, 5, and 6. And then we'll go on from there. Be back shortly, guys.